Asia, I think governance is a very important framework to analyze the different companies, because to run a normal quantitative, say a Bank Graham net screen, where usually one of the criteria perhaps is the net cash as a percentage of the market cap, it has to be high, and then you come up with this list and you try to do further filtering. I guess this approach has met with quite a number of challenges, whereby a lot of high net cash companies in Asia, particularly from China, they went bankrupt due to governance and accounting frauds. So Munger talks a lot about incentives. He's the master of incentives, and master of psychology. So in accounting and auditing, there's actually the triangle of auditing fraud. So it's not just incentives, but you have to understand the opportunity. How are they able? It's just like after you perhaps murder someone, it's easy to kill someone, but how do you dispose of the bodies? So that's the opportunity part. Everybody knows earnings management, but how perhaps do the insiders and the so-called management try to tunnel out assets and expropriate the assets out of the company? So it can be high net cash, but the cash is actually not there in the company itself. So perhaps we can use accounting to help us to understand how to go about to further filter out companies that can be true compounders. So take for instance the usual booking of sales in a normal accounting transaction. If it's a sales which is a credit sales, so it's debit, receivables, credit, sales. But in a lot of Asian and Chinese companies, it becomes debit, other receivables, credit, sales. So the distinction in other receivables is that the sales are actually booked and made to companies that are set up by the firm itself, that are related to them. So it becomes like a related party transactions, and they book it under other receivables. So in accounting research, we can run empirical tests. So the independent variables, the ones on the right hand side of the equation, would be other receivables, and then on the left hand side, the objective that you want to find would be future abnormal returns. So usually companies with high other receivables as a percentage of the total assets, they actually, this group of companies, they have negative future abnormal returns. So this is one good empirical tool that a lot of companies and investors, value investors can employ. But the limitation is that from the usual normal Bloomberg screen, it doesn't, for Asian companies, break down the receivables into trade receivables and other receivables. So perhaps you might need to do some reading of the footnotes, looking at the company annual reports, just like Buffett do. It becomes like a habit and enjoyment for him. It's like stamp collection, just reading through the annual reports. So how do the companies use this opportunity to tunnel out assets? So the first step, as I mentioned, would be debit other receivables to their related party transactions, companies that they set up on their own. But investors would find it hard to really find out whether is it related party transactions. So credit sales. So the second step would be to cancel out the other receivables, right? So they need to credit the other receivables. But how? So maybe subsequently, or in 6 months or a year later on, what the companies normally do is that they would announce very positive so-called announcements about some exciting, sexy projects that they're going to embark upon, or they chance upon a very synergistic acquisition target. So they would go again on roadshow, do some rah-rah, and then raise capital from investors and the capital markets. So with the sum raised again, they would go on all these bolt-on acquisitions or certain capex projects. So what they do is this so-called acquisition targets are actually the setup companies that they have booked the artificial sales with the other receivables contained in it. So by making acquisitions of these related party transaction companies, they are able to bring back the problems back into the list code, cancel out the receivables, so it becomes debit goodwill from the acquisition, which is carried as an intangible asset in the balance sheet, and credit the other receivables. So the receivables problem disappear. So they buy time again to roll over their problems to the next step, to the next so-called group of investors who would believe them. But as I mentioned earlier, from examples that I mentioned, such as the catering company that handled the Beijing Olympics, you can carry on this charade for perhaps 5 years, but one day you really cannot continue on. But during that period, it's easy to be misled. It's hard to know and hard to find out. And when things are going well, as Buffett always and Munger always say, when things are going well, nobody asks questions. So it's only when the tide is out, you can see who's naked. So, but before the tide is out, you can still see who's naked, by employing all these accounting tools and techniques to really go through the hard work of going through the footnotes and just thinking about the organizational structure and related party transactions of these various companies.
So if you were to devise a checklist for Asia in particular, of course, we're value investors and we have checklists already, but just to tweak them for the Asian accounting environment, what types of things would you include on that checklist to uncover these shenanigans that occur, let's say specifically in Asia?
Actually, it's a very clumsy kind of quant screening that actually is a sharp tool in Asia. So it's the blunt tools that are the sharpest in Asia for value investing, ironically. So the blunt tool is actually to have a list of the super no-nos, the toxic factors, in my view, whereby companies with, for instance, the usual high debt, the usual high receivables period, high capex as a percentage of sales, because a lot of companies, they capitalize expense to boost artificially the net profit margin, as well as the one that I mentioned earlier about the other receivables as a percentage of total assets. So you have a list of all this, so there can be, in my view, a clumsy set of 20 to 50 of these variables. So after doing this clumsy screening, you come up with a list. Perhaps if it's 1,000 companies, what's remaining is perhaps 300 or 200. So it becomes a very sharp tool, back to the Buffett early days, whereby he offered us a solution. So I guess everyone remembered what Buffett said when he was just pouring through the value line and his annual reports. He said, and advised young people and young investors and young fund managers, he advised all of them saying, just go through companies from A to Z. So that's why everyone, including his investor base and client at that time, when Buffett was starting out, they are just amazed at Buffett's so-called memory and recollection of companies. So they just mention, oh, there's this particular company, what do you think? So he's able to remember their market cap, their sales, their profit figures, their historical track record, and in relation to the industry peers and related companies. So he's able to, because of his ability to go from A to Z, a knowledge base, how long over many decades. So he's able to, people always say it's the heuristic that he employs is a very blunt thing, but this is what I meant. After going through the clumsy screening of 20 to 50 of the variables I mentioned, like other receivables as a percentage of total assets, to ferret out related party transactions that are shoddy. So the next step would be to go through from A to Z, this 20 to 30% of the remaining list, and that actually would be helpful if you're able to find a dedicated investor in Asia who just love and very curious to find out about companies and business models and people. So maybe I'll just give perhaps an example of how a net company can still work in Asia. So for instance, I mentioned in Malaysia, there's this company called DKSH. So from a net, it satisfies almost all the net criteria. So it's one of the rare ones. But the next step in the screening process would be a qualitative assessment. So in Malaysia, for instance, a lot of companies, they cannot stand on their own, as Buffett would usually say. Are they able to win sales based on their own economic competitive merits, rather than being dished so-called contracts based on government favors or relationship-based sales? So DKSH is actually a subsidiary of the Swiss-listed DKSH Holdings itself. So when the DKSH Holdings that's listed in the Swiss Stock Exchange, when that's traded at 20 over times PE, but the one in Malaysia is trading at 5-6 times PE, and Malaysia accounts for about 10% of the earnings of the Swiss listed group. So it's like a no-brainer. You know you've got a Swiss governance and Swiss know-how in the business model, and yet the valuations are so compelling that it's like a no-brainer picking. And true enough, recently, while the Asian markets have underperformed, particularly Malaysia, because of the political uncertainty, the stock has been up 30 to 50% in the past 2 months. So I guess this is a classic example of how you can employ a blunt sword that's so sharp in Asia.